Good Sunday morning, everybody. I hope everybody's having a great day. Let's talk ETFs. We're going to have a new ETF review. I haven't reviewed a new ETF in a while. Today, we are going to talk about VYLD from JP Morgan. It's JP Morgan's volatility bet. So it's going to be similar to SVOL and ZVOL for my regular viewers. All right. Hey, Max fam. Welcome back to the channel. All right, so I've already told you, VYLD, it's JP Morgan's brand new inverse VIX short-term futures ETN, not an ETF. It's launched just the other day. Now, what it does, it's trying to dodge the ghost of Volpocalypse, and it has a different formula that's supposed to make a blow-up proof. But we're going to compare it to the crashed and burned ETNs of past, and I'm also going to look at the benchmark, and I'm going to show you how the benchmark's calculated without getting too in the weeds. And I'm going to explain why this, in theory, or why JP Morgan is saying that this should blow up. I'm not saying that. But it does look like a more sound formulation for a benchmark. Let's just say that. All right. Then also we'll just look at, well, I'm also going to kind of compare it to SVOL and ZVOL because those are two funds that short volatility that we already know about. Now I'm going to tell you right off the bat, this fund, because my channel has a lot of people that like yield, like high yield on it. This fund does not pay a yield. This fund is a growth fund. I didn't realize that when I was working on this last night, but that's fine. It actually can work out fine. So think of it more like an SVXY instead of an SVOL and a ZVOL. But you could. It also has similarities to SVOL and ZVOL. Okay. So it's an ETN, exchange traded note. It means it's a debt note backed by JP Morgan. So, if JP Morgan goes under, presumably this does too. Now, the thing is, this is based on an index that no other ETF that I know of is based on. It's the inverse, the S&P 500 VIX. So it's the VIX short-term futures point change inverse daily total return index. Okay. So it has an 85 BIP expense ratio, it's kind of expensive, but it's the first one of its kind. And if they can make it where it's blow up proof, maybe it'll be worth it. I don't know. That's for you guys to decide. Let me know. All right, let's get in the Wayback Machine. So February 5th, 2018, I remember it well, the Volpocalypse. Okay. So VIX doubled overnight. And more than doubled. It went from 17 to 37. So it's 115% up overnight. So funds that were short volatility, so they make money inversely. There's one called XIV. And there were some other ones too, but XIV tracked the percentage change in VIX futures. So, if a 20-point VIX jump meant 100% loss. So in other words, it inversely tracked the percentage of VIX futures. So yeah, if VIX was ever up more than 100%, the fund would blow up. And sure enough, the fund blew up. So it got delisted. Okay, SVXY is pro shares. It's out there today, and it survived. Now it had to reduce its leverage from one time leverage to half leverage. And it had a 90% drop also. But the thing is, this new benchmark, or the benchmark's not all that new, but the new way of calculating it's better. What they do is on the benchmark, they scale the positions to make it where they lose 1% of net asset value for every futures point that goes against them. I'll explain that more in a second. So it uses points change, not percentages. So say VIX jumps from 15 to 20. This is a good example. Okay, that's 5 points. So this fund, VYLD, would drop 5%. That'd be a bad day. Okay, but the other funds, the way the other benchmarks are formulated or calculated, would cause a 33% drop. So that's why these other VIX funds like UVXY and SVXY and anything VIX based is extremely, risky. And a big part of the reason is because the way VIX trades, it trades in percentages, and all of these databases are based on percentage changes. Now, there's still some good VIX funds out there. I'm not saying that. I like a lot of UVIX, UVXY, great ETFs. Nothing wrong with them. But it's important to understand the difference. This is going to be the first one that I know of where if futures jump from 15 to 20, yeah, the fund's just going to lose 5%. All right, so it's going to more mimic how you think of stocks, because stocks trade in points, not percentages. But VIX is the instrument that trades in percentages. Now, I wanted to look into this. I wanted to look into it myself. So what I did is they have a back test, or it's S&P Global that publishes the index, and they have a white paper and everything on it. But I'm just going to show you the chart here. But I actually last night hit export, and I downloaded the spreadsheet. I looked at the numbers, and in 2020, I looked to see how the ETF wasn't around, but I wanted to see how the benchmark, because the ETF tracks the benchmark. Let's see how the benchmark handled 2020, because 2020 was bad. From top to bottom, the benchmark was down 52%, where the market was down 35%. However, that was just for one day. There was like a one-day shock. By the next day, the ETF was, or the strategy, the VIX inverse strategy was only down about 40%. But in any event, yes, this showed some volatility in excess of the market in 2020. But I'm going to excuse it from 2020, because look what happened in 2022. In 2022, just on the chart, you can tell it was up for the year from 2022 to 2023. And that was a bad year in the market. So I went to the spreadsheet and checked it. And yes, it was up for the year. And so then not only that, you can also look at their own numbers. Yeah, they had the benchmark was up 5% in 2022. Okay. The S&P, just for comparison purposes, was the S&P was up 18.7. Was down 22.05 in 2022. I just looked it up. It was down 22%. So that's an incredible advantage. Because this fund was short vol. Now, the difference between 2022 and 2020 is vol blew up in 2022, but slowly. You didn't have some, just like 2020 was, hopefully once in a lifetime or once in a generation. 2022 was more of a garden variety bear market. I like the way this fund handled it. Now, look, the other thing I like, look at 2023. This fund was up 26.43%. The SPY was up 25 something percent in 2023. So it outperformed in 2023 by a little bit. And it definitely outperformed by a lot in 2022. 2021, it was up 29%. I don't know if the SPY was up. The SPY had a good year. The trade-off was, for the year of 2020, the benchmark was down 11%. But still, if you look back at a 10-year record, 9% annualized, 5 years, 11%, 3 years is 13%. 3 years includes that really good. 2022 was a great year for this strategy. It's built for that kind of strategy. Maybe that's why JP Morgan released that right now. What did we just lose? We just lost the 200-day moving average. 7, 8, 9 days ago, I guess. JP Morgan, they have to file for this before. It could be the perfect fund. If this is going to be like a 2022 pullback, this could be the perfect ETF to write it out in. Now, do your own research. It's go to JP Morgan's website, go to the S&P Global, and they have white papers on this. You can research all this stuff. This stuff's very interesting to me, as you guys are aware. All right, so let's talk competition now. So the things that are out there now are SVOL and ZVOL. All right, so SVOL is from Simplify Volatility, or it's from Simplify, and the name is the Volatility Premium ETF, SVOL, Simplify Volatility Premium ETF. Anyway, Simplify does a great job. They have some excellent funds, some good alternative type funds too. I like them. This fund has $1.2 billion under management and just a 0.5% expense ratio, 16% yield, give or take. It shorts VIX futures, but it uses less volatility, like lowers the volatility compared to those old funds that blew up. so it can harvest some volatility premium. Then on top of that, not only does it cut down on the exposure to leverage, then it buys a VIX, an out of the money VIX call option to kind of cap max losses. Anyway, it's a good fund. ZVOL is also a good fund. ZVOL is a little bit more aggressive and probably twice as risky. Now it only has 50 million under management. It costs a full percent. It's from Volatility Shares is the name of that company. I don't know that much about them, but they do have some interesting alternative funds also. Anyway, what this fund does is they short VIX futures also, but they don't short the near month like everything else we're talking about does. They short months 4 through 7. So those months aren't as volatile. So that's kind of the way they deal with blow up risk. They just go to the more mellow part of the term structure to do their arbitrage strategy or whatever you want to call it, to harvest. These guys they're doing something called harvesting roll yield. Futures have something that's called roll yield in the same way that options have theta decay. So when futures traders harvest roll yield, just like an option trader harvests theta decay, it's a different strategy, and we aren't going to talk about it that much. But anyway, it's the same idea, right? Okay, so like we said before, VYLD's twist is they're going to use the full leverage. They aren't going to use reduced leverage like SVOL, but they're going to use the points-based scaling instead of the percentage-based scaling. Anyway, this ought to give it some definite stability. Okay, now look at this, though. Here was SVOL versus ZVOL, and I just wanted to show why I thought ZVOL's in black, why I thought it was about twice as risky. Now, this is just from the December 10th top, and I don't know if December 10th was the exact top. I remember it because this day I bought a bunch of Yield Max, and it was within a day or two of the top. So I just used the date. So if somebody was in ZVOL and SVOL pretty much at the top of the market, a quarter ago, seeing that initial shock when the market dropped really fast, ZVOL dropped about twice as much. That's why I'm saying ZVOL's risky. And then it also dropped a little faster, although SVOL finally dropped to about the same percentage amount in the most recent drop. They've also bounced back to about the same. You can also see here ZVOL paid $1.46. Now this is for a quarter year, but so call that $1.50. So that's $6 for a year. So this thing's paying about $6 for a year. Costs $16. So it's a little bit. That's about 25%. That's a pretty nice dividend. Now SVOL, on the other hand, paid 80 cents for a quarter. So what does that equal? $3.20 for a year. So $3.20 for a year on a $19 stock is a little bit less, maybe 18% or something. In any event, that also could account for why ZVOL is a little, what I'm saying, riskier, because it pays out a little bit more. That also adds a little bit of depletion risk, if nothing else. Okay, so here is ZVOL compared to the SPY, and ZVOL just been spanking the SPY on total return, just absolutely spanking it. But then the past year or so, kind of, it has not been doing well, compared to the SPY. Here we have SVOL. Now SVOL is more pacing itself with the SPY, but you could see for about a year ago, SPY pulled ahead. The volatility market has not been as good in recent months, and there's been other influencers, not me, but I'm thinking mainly Victoria Media has had content on SVOL saying that SVOL was going to lower its dividend, which it did, and wasn't going to be as good going forward and stuff like that. And you can see it. It hasn't been as good going forward. For a while there, SVOL and ZVOL were easily spanking the SPY, but then starting about a year ago, the volatility started underperforming the SPY. So, all right, it's too early to tell. VYLD, I think their first day was March 20th. Of course, there's no track record. Of course, the JP Morgan back test and the S&P Global, all the information we have with regards to the back test or any type of track record would be very preliminary. It's all based on a bunch of assumptions, but it's designed to be like SVOL and calm years, but with 50% less drawdown and chaos. And that would be great. That would be great. SVOL returned 15%, give or take, in 2024. ZVOL was total return of about 8%. Now it paid a higher yield though, but total return was a little bit lower. Now VYLD could be a good mix of both of them, I'm thinking. Anyway, so remember, this is an ETN. You're putting your faith in JP Morgan, you know, and VIX can be an evil instrument to trade. So there's no guarantees on any of these things. It is good that they're leveraged to the point move and not the percentage move. But outside of that, you know, the jury's still out. I said the slide on here I typed yesterday. I said if it pays a good yield, I might take a starter position. That I know it doesn't pay a yield, like I've said before, and but I am thinking about a position in this. What I'm thinking is, if you talk about the market we have now, we're under the 200-day moving average and have been for about 5 or 10 days. Well, where did this back test really excel in? It excelled in 2022. What happened in 2022? In 2022, we went under the 200-day moving average in like February, March, and stayed under the 200-day moving average. I want to say until like December. We were under the 200, maybe November, under the 200 the whole year. We popped above it a little bit during summertime, but it was a total fake out. But other than that, we were under it the whole year. Okay, this fund, and the fund wasn't around, but the benchmark performed very well and was a huge outperformer. I wonder if JP Morgan thinks we're going to have another 2022, and they probably do. And I think this thing is positioned. This fund is positioned perfect if we have another 2022. If you can trust the back test from S&P Global. S&P Global has a pretty good reputation. I don't know. Leave me a comment. Subscribe. I'll put the link to, I have a Discord. It's free. I'll put the link to my Discord. If you want to find me, that's generally the best place to find me. Come join my Discord if you want, or leave a message. I'll check the comments for this. And like I say, I will put the link to the Discord in case you're a Discord person. But yeah, this could be the right fund for the right time or not. Let me know what you think. All right. See ya.